right, nice to be with you. It is such a busy morning. Obviously, we're continuing to watch what happens in the Middle East, but we also have a decision from the U.S. Federal Reserve today, and the market's going to be watching what the Fed has to say, not just about what they're seeing today, but where we go from here in such an uncertain time. Now, just as a reminder, the Fed is not expected to make a move on interest rates today, but let's say they were to walk back rate cut expectations. What would that mean? And, of course, what is their view on the overall economic landscape in the U.S. when here in Canada there are growing concerns about things like a recession? Karl Schamotta tracks it all and what's happening in the currency market as well. He's chief market strategist at Corpay. Karl, it's good to see you.
You as well.
Okay, happy Fed Day.
To all those who celebrate.
Yeah, exactly. What do you think the U.S. Central Bank plans to say to the stock market today?
Right. I think they are going to stay very neutral, take a very wait-and-see posture in terms of the communications in the statement and what Powell says during the presser. But as you mentioned, the real crux of the matter is what they say about the future. And the statement of economic projections that gets released alongside the statement itself, that is going to be the thing that moves markets, right? And so basically markets at this point are waiting to see, does the Fed tell us that they're going to deliver 2 cuts later this year, as had been set out in the prior statement of economic projections, or are they going to adjust it to just 1 cut? And you know, that may be the case given that the window is sort of closing to continue easing, and that you know, we have the threat of inflation coming from potentially the tariff increases, as well as the increase in the price of oil that we've seen in the last couple of weeks.
That was what I was going to ask you about. I think I just sort of jumped right to dessert before talking about, you know, digesting what the meal we're looking at is. Where is the U.S. economy right now, and where is the inflation issue?
That's the fun part. So right now we're looking at, you know, the data under the hood is pointing to a slowing in momentum, right? However, Fed official after Fed official has told us, you know, they're still looking at strength in the labor market. They're not totally convinced that all of the soft data from the consumer consumption end of things or business investment is going to translate into weakness in terms of actual growth, right? And so, you know, they're looking at all of that. They don't know which is, you know, whether we're going to see softness in terms of underlying activity or whether we're going to see a rebound in inflation. And so that's a big risk, given that, you know, we have seen an increase in inflation expectations among American consumers, largely tariff-led, but potentially we could have another leg higher here on the basis that gasoline prices are likely to rise a little bit, right?
Because oil prices are going up, or just because of summer demand, or both?
Both.
Yeah.
But, you know, it shouldn't be a major increase, but it is something that psychologically impacts expectations. And I'll say all of that before saying that at the same time, if we look at the U.S. personal consumption basket, the amount that households actually spend on energy, it's been going down over decades, right? It is not a material input into the inflation process. What Fed officials are concerned about right now is the expectations avenue. They want to make sure that we do not have another rebound like we had immediately after the pandemic, in which consumers get, you know, sort of concerned about price increases coming down the pipe.
And we also move on story to story as fast as you move on TikTok video to TikTok video. I mean,
Indeed.
There's also the big, beautiful bill.
Right.
You know, one could argue that the fiscal spending concerns are also something that the Fed has to consider for things like inflation as well.
I think so.
I mean, it's longer term.
It's very long term, yeah. And it might impact, you know, things like their estimate of neutral rate. But I don't think in the near term that's actually going to be a driver. It also, even in markets, seems to be a little overblown, right? We're talking a lot about it, but if you actually look at most of the metrics that influence where the dollar's at and where Treasury yields are at, those are being driven by a reassessment of U.S. growth characteristics.
I do want to tie in Canada in just a second, but we spoke to Fitch's head of U.S. economic research earlier today, and he talked about the possibility of a Fed shadow president. The idea that Donald Trump, who never shies away from commenting on Fed strategy or even his views on the Fed chair himself,
right.
Let's not be surprised if there's some commentary from the president on whatever the Fed says today, but also the possibility that you could see a successor to Jay Powell named before Powell has actually left the job, and whether or not that's somebody who's going to be commenting. What does that dynamic, the political dynamic in the U.S., where typically we don't really see a lot of noise around what the Fed is actually doing from the White House. What does that mean, do you think, for how markets have to interpret all this stuff?
I think it should be taken off the table largely. I don't
discount
think
it. Markets should discount it.
Markets should discount it, at least in the near term. Like, there is the possibility that when Powell leaves, he's replaced by a more dovish candidate, and that should influence longer term bond yields. But in the near term, as far as we're looking at any given decision, the reality here is that this is a institution that is well insulated from political pressure. It is staffed by people who, have a devotion to the job and to the data, as opposed to, listening to all of the noise, including Powell himself. And so I don't think that we're going to see, those decisions shifting on the basis of pressure from the White House in the near term.
Okay. And then as for the Canadian story, obviously, many would make the argument that we're in a much weaker spot and we're still navigating trade uncertainty. And, I think that the Bank of Canada has said they're still concerned about certain kinds of inflation as well.
Right.
But we also alluded to the fact that the minutes from the June meeting were indicating a cautious tone. So how would you characterize where Canada's economy is right now?
Yeah, so I think, the Canadian economy is clearly losing momentum and has lost momentum from the beginning of the year. Trade shocks have hit it very hard, but there is a lot of uncertainty. And so firstly, if we look at what the Bank of Canada said yesterday, the Bank of Canada is saying, we are going to look through tariff-led price increases. We don't think that those reflect long-term inflation pressures. We think that the economy needs further easing. There was a lot of discussion about cutting rates again. That has put, rates in Canada under pressure. And then at the same time, we have all of these sort of positive attributes. The fact that Canada is running a lower tariff regime than other major countries relative to the U.S. The fact that we have fiscal spending coming in, and most powerfully, perhaps, the fact that the Bank of Canada eased rates so much last year that the lagging impact of that is hitting, the Canadian household sector and the economy more broadly. So the challenge that we have right now is, if we can get through sort of a soft spot, perhaps we come out a little bit stronger than had been anticipated, and the Canadian dollar may prove to have been undervalued for a while here.
So that was going to be my final quick question here. So the loonie has enjoyed some momentum against the U.S. dollar.
Yes.
Based on what you're saying, you think that could feasibly hold?
It could hold, yeah. There is a big contradiction going on right now, right? So the yield differential between Canada and the U.S. currently points to the Canadian dollar being quite overvalued. The fact is that rates in the States have stayed high and are not looking at coming down anytime too quickly. And so the Canadian dollar has rallied past that and sort of outperformed where that rate differential is. But on a longer term basis, if we look at the gap between Canadian and U.S. unemployment rates, that has widened slightly, but the Canadian dollar is essentially in line with where it should be on a long term basis. And I should point out there, or give credit there, Doug Porter from BMO originally pointed out that relationship, but it is like the most accurate long-term predictor where the Canadian dollar goes. What is the difference between U.S. and Canadian unemployment rates? And so right now, that suggests that we're very close to fair value, meaning that it'll be very difficult to break out of the range that we're in right now.